Hello, everyone. This is Joseph Trevisani from Worldwide Markets. Good morning, good afternoon, good evening, depending on where you are in the world. It's always interesting to broadcast to potentially at least the entire globe, no matter who is awake and who's not, at least as far as societies go and the taxi cabs. As always with my webinars, I prefer to do these as colloquiums. If you have any questions, comments, jokes, anything you'd like to bring to the attention of myself or others during the webinar, just please type it into the chat box and I will see it. I have the chat boxes live. And other than that, I thank you all very much for attending. I always take it as a great compliment that people would take time out of their day to listen to what I have to say. So today, we have something I don't think I've done anything on this topic before. It's a very macro topic, but it's also a very trading topic. And it is commodities. And where are we and what is going on with the commodity complex? Why has it changed so drastically? And what does that predict, both as an economic factor, meaning are commodities still the leading indicator for many things? Or has something changed dramatically in the past 15 years so that commodities are no longer as reliable a predictor of economic conditions as they were? As they used to say about vaudeville shows, and I think probably variety shows on TV, there's a little bit of something for everyone in this particular topic, and that's certainly true. If you're looking for macro issues, they're here. If you're looking for worldwide growth and expansion issues and economic history, it's here. If you're looking for currency influences, it's here. If you're looking for the interest and impact and rising impact of central bank rate policy, it's here. If you're looking for technological future, not futures, future, it's here. And if you're interested in the internet, it's here as well. So the number of strands that we have to account for on this particular topic is a little difficult. So where we're going to start is actually with the facts, and then we'll move on. And when I say the facts, I mean some actual numbers or charts, at least, from various commodities, and I'm using the Bloomberg Commodity Complex, commodity index for most of the stuff here. The charts are all Bloomberg, and I thank Mr. Michael Bloomberg for creating this company since it makes my life a whole lot easier. Okay. When we're looking at let's go to the commodity index right here. Okay, let's bring up the commodity. Okay, let's start with this one here. Sorry about that. I just want to find the right one here. Sorry. Here, Bloomberg Commodity Index. Okay, this is the Bloomberg Commodity Index going back 25 years. Yes, I take commentary and criticism as well. If you can always do that, and I don't object. I think input from people who are listening is exactly what's necessary, both as an educator and as a commentator. I think it makes for much better presentations. Okay, I like Q&A, in other words. Okay, this goes back 25 years. There are two aspects to this that I think are interesting. Now, indexes work as variation on a baseline. So, I don't know what the Bloomberg complex, the Bloomberg Commodity Index is set as a baseline, but it's a variation on that particular baseline. I will get to as many of those as I can. I think we'll probably cover most of it. The fracking will certainly come under the oil. The Chinese economy is a huge factor, certainly as a representative of the BRICS and everything else, and Australia as a representative of resource economies. But I'll get to as much as I can. I am trying to focus on the topic, which I think it's more beneficial. But anyway, let me go on. So for the index. One thing I think is interesting about the way you look at an index is because it gives you a progression in time. I don't just mean history, but changes based on a baseline. So for the basic macro issue with commodities, and I'm not discussing anything more than short-term scarcity or not, because one thing that's true, and it's one of the baseline assumptions I'm making when it comes to analyzing price in commodities, is that scarcity, except in very rare situations, tends to be temporary. Because higher prices bring out two things, exploration and technological development. And we've seen this in commodity after commodity. In the 70s, people were writing silly books about the world's about to starve by 1985. None of this ever happened. Why? Because technology provided, human invention provided the mean to increase food production. We see this with oil. That silly theory of peak oil and how there's going to be no more oil. There's plenty of oil. What happened was brought out exploration and new technologies. Now, I'm not arguing or discussing whether or not fracking is good or bad for the environment. I have my opinions, but they're not part of this discussion. The idea of permanent scarcity for commodities has not proved to be true. It may be true in the future. There may be a dystopian future out there for all of us and my children. I hope not. But so far as reality goes, it has not proved to be true. The other interesting thing about an index, a chart like this, is that as the world uses more goods, produces more goods, there are more people, the index rises. So what we're seeing with this price index over 25 years is a higher level of general use, but we're seeing an enormous variation in price. Far more than would simply be generated by an ever gradually rising level of use for all the commodities and represented by this index. And it's kind of phenomenal. When you look here, back here, right, in the in the 90s into 2000, you had a variation, and you can easily say and make the case that the variation between here and here is a speculative interest, right? Ties with business cycles, all sorts of stuff, world economic growth, da-da. But suddenly here, in 2000, things start to go a little different. We are entering, it appears, a different world. As far as, because the economic growth we have to be careful considering, because there are factors in here which are economic growth factors. But the economic growth factors are one order with, China and India and all of the emerging market countries becoming much more industrialized and using much more products and much more resources. The factor of price, which is what we're looking at here, is far greater than the factor of economic growth. So it's clear that this period right here, and I think here as well, although perhaps we're ending it right here, is a period of increased speculative interest in commodities. Can we prove this? I'm going to give you the best example that I know of it. Let's see which one here. Which one do I want to use here? It's the story of, not that one. We need one going back a little further. Yeah. It's the story of oil and Goldman and Merrill Lynch and other things. And this is another factor. First of all, let's look at the speculative factor. Okay? This one right here. This is the commodities index. This is WTI. This is the famous run-up in prices, in oil price up to 150, 149 something, in I guess that was mid 2008, just before the crash. Or I could be wrong about that. It could be 2007. No, I think it's 2008. Okay. What happened there? Look at this. Oil from going back, there's almost no variation, but look at the difference in price variation. Exponential between here and here. Post 2000 and after. Now, I'll tell this story again. I've told it before. I'm going to make it pretty short. What happened here? Now, remember, prices in commodities are determined by more than one factor. I know this is basic stuff, but let's remind ourselves. It's determined by supply and demand. It's determined by economic growth factors. But there are also markets. And markets are not particularly interested in all of the other factors except as they relate to price direction. Does the market care? Do traders care if economic growth is changing? Yes, of course. Projections are changing. What do they care about? They care about what it means for price direction, as do all of us with all markets we trade. So the actual economic factor is once removed. It's through price action, the potential effect on price action. But there's another factor, and that is the degree of speculative interest in the market. If there are 6 people trading oil, and all of them use oil, then their interest in price is going to be largely determined by what they think they can utilize. If there are 100 people trading oil, and only 10 of them actually use oil to produce petroleum products, then the others are not nearly as closely tied to what they actually need to deliver, to take delivery. And what happened around 2000 with the NYMEX and I believe the London Exchange, as the LME, I think it's the LME, Goldman, which gets a lot of blame for everything, and Merrill Lynch and another number of American companies, thought that and let me show you one more. I just want to put this up. This is the WTI with the Fed funds rate. This period here, leading up to the Fed funds, leading up to about 2000, the Fed was dropping rates, especially after 9/11, kept them low for a long time. This is Bernanke's rise and all that stuff. But anyway, what was going on? And if you look at it, I don't have a long-term chart, but if you have a chart going back 30 or 40 years for the worldwide central bank rates, you see one striking condition: long-term decline. In America, since the peak with Volcker in the early 80s, stamping out inflation when Reagan was president, to now. The progression is striking. It is very different than the prior history of 100 years in interest rates. What do you get with lower interest rates? You get two things. You get a declining ability for fixed interest rate investments. They're returning less because they're keyed and tied to, very often, the overall interest rate value, the overall interest rate level in the economy. And two, you get an excess, a plethora, an abundance, a whole lot of low-cost money. And I don't know what was going on in these people's minds, but in the late part of the last decade, the late 1900s, 1990s, sorry, a number of people at Goldman and Merrill Lynch and others moved the idea that the NYMEX, where oil has always been traded in the United States, down here in downtown in New York, where limits on who could participate in the market were pretty tight and closely allied to people who had an actual delivery interest, meaning oil producers, oil users, chemical companies, stuff like that. Not exclusively. And, of course, there were always the locals on the floor who were purely speculative. But nonetheless, the market was much more closely tied to the facts of delivery, the facts of industrial use, the facts of economic and business growth cycles. That gave you that much tighter variation. But sometime in the late 1990s, they approached, I guess, the LME, but I'd have to check that, sorry about that, on opening up more types of oil contracts for traders in Europe, or in London, basically. And the restrictions in the UK became much wider, meaning there were far fewer, so that far more people could participate in the market. Now, these people were not you and I, basically, but they were financial institutions, of the great hedge fund boom, which is also and has been predicated on an era of low interest rates. Because in order for hedge funds and leveraged companies to get money, they need to borrow it. They leverage up on their capital base. Well, if you've got to pay a lot in interest because interest rates are high, you can't leverage very much. And if interest rates are really low, guess what? So there's very little coincidence in the development, the boom of the hedge fund industry and worldwide low interest rates. In fact, they are as inextricably bound as can possibly be. Or as my little girl said, well, never mind. Well, that's not appropriate. Well, anyway, that's not important. So the London exchanges reduced many of the tighter restrictions that were available in the United States as far as who could trade oil on the markets. So guess what? You got an enormous influx, boom, of people trading this particular commodity. That's what generated this run-up more than anything else. Now, there's another factor involved here as well, which helped it. But the basic fact of the market was that there were more and more people in oil driving prices one way or the other because of the changes in participation rules of WTI. And I think this applied to Brent as well. And, of course, very soon the NYMEX changed its rules as well. Why? Because they were losing all their business to London. So a basic fact of the commodity markets in the past 15 years, and this is also true because of the technological changes involved in the Internet and ability of access markets, and not just for you and I to buy something from Amazon or any place else, but for months and other big players in the markets. It is far, far easier now to access worldwide markets, to fling your money around the world at the drop of a computer key than it was before. So that factor as well. The other factor is that through this period here, it's a growth period for China and for all the emerging market countries. And so the speculative interest tied with the directional interest of worldwide growth and the low interest rates, so you can borrow a lot of money, all pointed in one direction. Economic growth pointed greater use of commodities. It also pointed to an era of perhaps temporary or maybe permanent, but at the time, scarcity, meaning that the productive capacity hadn't quite caught up. It takes a while to develop a mine. It takes longer to, although less so with oil, but there's a lead time for developing more supply, although supply will eventually balance demand and back and forth. And there is the economic growth factor of countries around the world which are growing, so you can just speculate, well, there's going to be more use. Everybody's growing. And the third is interest rates. So all these factors combined to produce this type of spike in oil. And this also, but this is not just oil. Let's look at, again, the Bloomberg Commodities Index. Same time frame. Same time frame. Now, you have, let's reduce these charts a little bit so you can look at both of them. You know, I don't like to put too many charts on one, too many graphs on one chart because it gets looking like some sort of modern painting, which may be good for your wall, but it's not very good for drawing conclusions and drawing analogies and stuff like that. So here are one of these is WTI with this huge spike. All right. And this is Barcom, and I have it on both charts here so you can take a look. And you can see that the time frame is identical, of course. So the change in use, and I don't mean industrial use, of commodities means that in the era of low interest rates, and let's take a look at that. I think I have that here. Here it goes. This is the WTI and Fed funds rate. Meant that all of the factors that were involved in commodity prices, the trading factor, the facilitation factor, the interest rate factor, and the economic growth factor were all pointing in the same direction. So you ended up with this huge interest and spike in trading commodities. Well, what happens when commodity prices rise? No prizes for answers on this. You get an enormous amount of investment into providing that commodity. After all, people want to make money. But what happens when the cost, I mean, for most companies, most firms, industrial or otherwise, the two biggest factors in ongoing profitability, as on the cost side, are wages and interest rate costs. Well, through the period from 2000 on, and you know, I should have brought a slightly longer chart in Fed funds. This is the Fed funds rate here, over here. And when you're looking at these levels on this chart, they seem very high, 5 and 6%. But when you look at it historically, these are not high. So as what I said earlier is over this entire period, there is a long-term reduction in worldwide interest rates. So you have prices higher in the commodity complex than they might be because of a certain influx of speculative trading, more than before. You have a picture of economic growth around the world, which is getting way, which for places like China and India have very high rates, and so prone to wow. You know, the Chinese, if we sell everyone in China one pencil, will be millionaires, billionaires. That factor, and you have low interest rates, looking for places to earn money, and it's cheap to borrow. So one of the great penalties, and the Fed is starting to realize this now, although I don't know how much, and other banks as well, one of the great penalties of permanent artificially low interest rates, not letting the market determine, is you have all sorts of firms and investment looking for a home. If money's cheap, your only thing you can possibly say is, look, if we're going to fund some development with borrowed money, Let's do it now. Money's cheap. We can borrow it now. Does that mean that the money will find a useful investment, one where the chance of positive return over long term, except perhaps at elevated commodity prices, is real? No, it doesn't, of course. Because once the reality of the world is limited. The reality of speculative hope is not. And the two, in the era of low interest rates, have been clashing, although it's taking a long time, naturally, to realize it. So, the period here is one where there's increasing worldwide investment. I don't have a chart of, say, the amount of investment in, say, just basic commodities, industrial commodities. Let's do with the mining complex and things like that. But I do know, and I'll tell you, that the investment in mining and other industries in the era of low interest rates, in the era of speculative trading in the commodities markets, much greater than before, and in very Panglossian views of world economic growth, has been greater than all other periods and probably many other periods combined. So there has been a huge amount of investment based on these factors, one of which, or two of which, are essentially artificial, and a third of which is probably exaggerated. And the two artificial ones are, of course, the price levels caused by greater trading interest in the commodities markets. The second artificial one, of course, is low interest rates. The third, economic growth, is not artificial. There is a great deal more economic growth around the world. The world economy is continuing to grow and has grown. And China and many other countries, India, of course, China's used example, have been tremendously successful at creating wealth and growing economies. Nonetheless, it's certainly true that the idea that this is going to continue forever has gotten completely out of control. It's also true China's not going to grow at 10% forever. It's not going to grow at 7% forever. And it does seem, for the moment at least, that if you looked at the Shanghai composite last night, 8.5% down. It does seem that the economic growth paradigm in China has been wildly, maybe wildly is an exaggeration, funded or at least caused, or its picture is far, its success, shall we say, is far greater, far much more due to government spending and loan creation than we imagined. In other words, it's not, if you build 50 apartment buildings, you get economic growth. But if there's nobody to live in them, then you don't get long-term economic benefits. And the same is true about mining and economic factory growth. It has been created by this era of low interest rates far beyond the actual growth rates of consumers. Because, and I mentioned this before, you have two different time scales here. The growth of a consumer society is slow. It's a generational thing. People don't change their habits very much. I know I've used my parents as an example. My parents' consumption habits were the despair of the Keynesians, of the demand side, because they never really did spend much money. They grew up during the Depression, and they were permanently scarred by it as far as their economic outlook. It was for my generation that didn't have that lived in an era and grew up in an era of abundance where spending is much freer. So it takes time, and this is certainly true in China and other large developing economies from a much lower base of consumerism. But it's easy to build a factory. You put a factory up in 2 years, and suddenly it's cranking out goods that maybe a lot of people don't want to buy. So all of these things are tied together in the growth of the commodities and the commodity price cycle that you see in the, now this is WTI. We'll go back to the commodity index here. Now let me just answer some of these questions here before I move on, because I have some other topics I want to get to. Okay, here we go. Iraq and its quotas, Iran and its restrictions on sanctions on Iran and fracking are all part of the same thing. They're all essentially part of the supply side of world oil prices. The thing about world oil prices is that how shall I put this? The playoff between supply and demand is not as easy to predict as most analysts seem to think. It is undoubtedly true that the huge run-up in oil prices here and the idea of permanent supply problems drove the investment in fracking. But what's permanently surprising, it seems, to all analysts is the degree of technological change. Meaning that what was originally profitable for fracking, $80 or $90 a barrel, within a few and very few years is not profitable at $60. In addition, for investments like oil, the sunk costs are high. The operating costs are low. So even if you are losing money on a particular oil well, most of your money is already spent. In a very real way, you might as well continue producing oil. So even though prices have fallen dramatically, I mean, WTI is trading at $47. Huge fall in the price of oil, in addition to the one from 2008. The supply does not diminish in a straight line factor because it's not one playoff against another. It's each individual producer making the calculation that it's better to actually stay in production than to go out of business. So you don't get the flexibility in oil supply that you would running through an equation. And, of course, you have, which we must not forget, the political factor in the Middle East, where Saudi's marginal production is determined largely, or at least a large part, by their view of Iran and politics and influence in the Middle East. So, well aside from GDP, you have factors in the oil markets that keep supply a good deal higher than you might were it simply an economic growth and profitability factor. Okay. The view forward, as far as for oil, at least as far as the world economy goes, I think, and I've long thought, that oil is not disappearing anytime within the next generation as the primary source of energy for most of the world. The growth rates of things like solar and maybe hydrogen use in cars and other things are very high, but they're coming from a very minuscule base. So that the period for the next generation, I don't see any lack of cars in the United States or anywhere else, and they all run on oil. And you can also say that even the Teslas and the other electric cars largely run on oil or coal, because that's where the electricity comes from. They may pollute less, and that's true, as long as you don't factor in the power plants. So the removal of oil from the economy is simply not a reality. We're not all about to retreat to the woods and live in log cabins and use wood to heat our homes. So oil's growth or oil's steady use will remain. So in that sense, it's quite closely tied to, it has a base. It's quite closely tied to world economic growth. However, the enormous increase in oil production has countered any rising price for oil in the past couple of years. So it's not simply true that as long as demand rises, so does price. So we need to keep that in mind. And the the almost intuitive idea that since oil is a physical resource, since the planet is a unit, since there can't be any more oil here than there was in the beginning, and that sooner or later we're going to run out, has intuitive sense to it. But it doesn't have a lot of reality to it. At least not to the limits that we've seen so far. And the change in the oil market in the past 5 years has been complete proof of this. It's almost unanswerable proof of this for the idea that we're running out of oil. We're not. Okay. So that pretty much covers the question here as to why GDP correlates so much with oil. It's the basic industrial commodity. It is the basic energy source for, if not heating and electricity in all places, certainly for motion and for industry. Industry runs on oil and gas, I'm meaning natural gas, but primarily oil. And that's where it comes from. And so that's why there's a very close correlation between GDP and oil prices, the basic industrial commodity. Okay. Now, let us move on here a little bit. Excuse me for a second. Let me close these charts. Let's look at some of the other prices. One of the things I wanted to talk to is about some of the currency effect. Now, there's one factor involved with this which I didn't talk about, and I am about to. Let me just find the right chart here. Okay, let's do it with, let me just show you some of the, one thing I haven't brought up here before I leave oil, okay? This is a chart on the NYMEX of WTI and open interest on the NYMEX. Now, it's harder to find open interest information on many of the other commodities. I have a few, and I'll show them to you, but this is by far the best. And I think oil is by far the biggest commodities market, I think. But look at the correlation in time between these two charts. The white is WTI on the NYMEX. And the yellow is open interest. Could there be a better evidence of the effect of speculative interest, speculative trading, meaning non-delivery? So I mean, speculation, from my point of view, is not a pejorative, not a dirty word. My background, of course, is currency trading on Wall Street in the 90s, and that's what I did. Anyway, so if you're looking for evidence that one of the main drivers of oil at 150 were oil traders at 150, it's right here. There is no economic reason for oil to be here whatsoever, but there is a big trading interest. Let me just take one or two of the others here and see if I can find this. So I'm saying you good picture. Let's see. Total open interest. Okay, let's look at this one. we're going to have to do these side by side. Now, I asked people, this is open interest in copper. You know, I asked friends of mine in the metals markets what the spike is here in late 2007. Nobody had a good answer. So unfortunately, I'm going to put this chart up anyway, even though I don't have the fact as to what's going on with that. Okay, but anyway, here we go. This is copper and open interest on the LME, the London Metals Exchange. Okay. These are not quite the same charts, but this one starts in 2005. 2005 is over here. So the interesting thing on this is the open futures in copper, once it rose from that, whatever it is in 2007, has stayed relatively stable within a certain degree. So its impact on prices has been less. Here's copper, July 24th. Okay, that's the price in copper. Actually, that's the chart we have here. Now, copper is a much smaller market, but the issue for copper is that it is not so much a basic industrial commodity, but of course it is, but that its use is far more indicative of potential changes, shall we say, in economic factors. It's a much better leading indicator. And that is part of the issue with copper and why commodities, and there's one other factor I haven't mentioned, that's of course the impact of dollar on all of these commodities. I'm going to deal with that in a second. That is why when you have copper here, now, you know, look, open interest here in 2015 is not that much different than it was in 2012. It's not that much different than it was in 2009. But look at the difference in price. I mean, you do have this spike in 2013, which does not, in open interest right here in 2013, this spike from like about the first 6 or 8 months in 2013 in open interest, that does not really correlate to a change in prices. There's nothing of the correlation that there was in WTI driving the WTI price up. So you have a different factor here, and it's also, I think, a reason why the price levels in copper, I have aluminum, I have several others here, but I don't know that I want to get into them simply because it's just more of the same information, retain more of its economic indicator status than, say, oil. And we all know that markets have trends, meaning that people will pile into currencies and pile into different markets for reasons that they hope to make money trading. So more people there, more trading. So, and copper is not exhibiting that right here. As I said, open interest is essentially the same over a 6-year period here, whereas price is not. But reversing that, the price level here, this was on Friday actually, is now back to the decline here, meaning pulling out of the recession and the financial crash, and back to here as well. But you do see here a general trend in copper, as you can see in others. Let's take a look at this, okay, of higher prices from 2000. There's aluminum. Same thing. Let's look at iron ore. Actually, you know what? This is one that's not so useful. This one actually changes. Okay, so you have the same effect, but less so in the other commodities that aren't so highly speculatively traded. Now, the last factor that we have not talked about so far, of course, is the currency impact, is the dollar impact, is what are all these currencies based in? And I'm going to do this using the Brazilian real, actually, rather than the dollar, because there's the investment factor of emerging markets that I can deal with, that I can bring up on this chart as well. Just for Adinda, I just want to know, are we running 45 minutes today, or are we running a little longer? Let me know. Just type it into the chat, would you? I've never met Adinda. I've worked with her for a couple of years now. She's based in Indonesia. I am based in New Jersey, although I live in New York. And it's kind of fascinating that we have worked together all these years and never actually met. Anyway. So what do we have here? This is the yellow is the Bloomberg Commodity Index, and the white, the Brazilian real. The one factor we've not, okay, I'm going to end this in about 5 minutes. I'm pretty close to the end. Thanks a lot. The one factor we haven't mentioned so far, and I deliberately left it for the end because we're currency traders, is the impact of the dollar and the dollar index, if you will, but just the general level of dollar on prices. Almost all these commodities, not almost, all of these commodities are priced in dollars. And the more the dollar rises or falls, the reverse effect, sort of like the bond market, the reverse effect you're going to find in the commodity price. So if the dollar is worth more, then a barrel of oil is actually going to cost less because it's expressed in the same value vis-a-vis other currencies because the dollar is worth more. So now the recent, certainly over the past, since last summer, the past year's decline or rise in the dollar value, both against the euro and especially emerging market currencies, which is why I brought this chart up here, has been a big factor on the decline in commodity prices. Another thing that we don't want to forget is in this era, this, interest rates at the zero bound in the world's largest market, the United States, for 6 years. 1, 2, 3, 4, 5, 6, moving on 7 years. At zero. What does that do? It generates money, maybe not for you and I, but for people who want to borrow it, and it sends it flinging around the world looking for investment here, there, everywhere, under every leaf, under every tree, whether the grass is greener across the street or not, it always appears to be. One of the places it's gone has been emerging markets and all their factors to build factories, to invest in their economies, to invest in their stock markets. And a lot of that money is now starting to reverse its course. It's coming home. It's expecting higher interest rates in the United States. It's positioning for that. And so the final impact on commodity prices has been this. Again, when the market for the commodity has a higher proportion of speculative interest, its moves are naturally exaggerated. For the question here, is there a limit to the $40 of oil? You know, there's on many commodities, and I would deal with gold here, but gold is so much more than just a commodity that I thought I have the chart, but I thought I would not cover. We'll do another session just on gold. Gold, probably my favorite thing because it includes, not my favorite thing, but as far as explaining markets, gold is fascinating. Yes, there is a downside limit based on supply and demand. The problem is that the price of that is determined by the market. So if you're looking for a base in oil, you could say, well, you know, there's so much oil, and I actually here's an oil chart. Where's one of my oil charts? Here, U.S. crude production. Okay, this is U.S. crude production and WTI. And lately, it's almost like nobody was paying attention until right about here, right? Late last year or mid last year, at the beginning of last year. And suddenly it became apparent that U.S. oil production was skyrocketing. And look at the price. Look at that price in WTI. Okay, so there's a sense that markets don't always pay attention, and sometimes they do, and then everything changes. Market views and their baseline assumptions about particular items, particularly economics and prices, often changes all at once very quickly. It just sort of flips. I think you've seen that in oil. But the baseline is somewhere determined by supply and demand. But for oil, it's determined by the supply more than the demand. Because the oil demand, let's see if I think I have a demand chart here in oil. Let's see, steel. Maybe I didn't bring the oil demand chart. Too bad. I'm sorry. My apologies. I do not have a chart of demand. I know I made one. I can't believe I didn't bring it. Not bring it means I forgot to email it to myself in a different room. No, I don't have it. I'm sorry. Demand is steady. The interesting thing about the comparison is the demand in oil is steadily rising. It has been steadily rising for 30 years or more. It's going to continue, actually a lot longer than that. It's going to continue to rise. As people buy cars in China, they're probably not going to be electric cars. The greatest portion of them are going to be petrol, oil. The same is true in India and everywhere else, in Indonesia and everywhere else around the world. So oil use has continued. It's more efficient. Its rate of growth is changing, but the actual absolute numbers of oil used in barrels continues to grow. However, so has the availability of oil. So it is more determined, I think, for oil by supply than by demand factors. And you can see that reflected here in the price. So I do not think there is a limit on the downside price of oil, and I don't know exactly where it is. I would say so far 40 has held for the past 6 or 8 years as a reasonable downside support based perhaps on supply side, but you have a new factor. The U.S. is now the world's largest oil producer. This has taken place in 5 years. I mean, look at this. The low in oil, forget about these dips here. With the low in U.S. oil production, it's close to 2010. And that's on a 30-year decline. And suddenly, it's not just higher than it was 10 years ago. It's higher than it has ever been, period. So when people, analysts, academics, perhaps others, make predictions and they leave technological development out of the picture is uniformly false. And there is no better chart, explanation, proof of that than this chart in U.S. oil production. Okay, everyone. I thank you very much for attending this and for listening. I hope it was both useful and informative. I hope it was mildly entertaining. And we will see you again next month, although there'll be fewer webinars next month because I'm going to be taking vacation in August and probably the last couple of weeks, so I won't be around for that. Again, thank you all for coming. I will put my email address up there. If you have any comments, criticisms, or questions, please send me an email. I'll be glad to respond. Once again, I'd like to thank FX Solutions, my own company, FX Street, and everyone involved there for the use of their facilities and for sponsoring these webinars. Again, thank you all very much for attending, and everyone have a good day. Take care.